How can you determine whether your business is successful? Ranking at the top of Amazon SERPs, getting more sales, or you might also think of reviews and ratings. Well, these are merely abstract measures of achievement. When evaluating the real success of your business, you must consider how it is operating financially. Even a well-established business can fail if it is not profitable. A profit and loss statement can assist you in measuring business performance and, as a result, business success. Hello everyone, I'm Ankita Patil, Product Evangelist at SellerApp, and today I'll be discussing a crucial topic: everything you need to know about Amazon profit and loss statements. So what is profit and loss on Amazon? Profit and loss on Amazon refers to a seller's financial performance in the Amazon marketplace. Amazon sellers can track their profit and loss using the Amazon platform, which provides a detailed analysis of sales, expenses, and earnings. The profit and loss statement on Amazon displays a seller's revenues, which include the total amount of money collected from Amazon sales. It also includes information about the seller's expenses, such as the cost of products sold and the other costs related with Amazon selling, such as fulfillment and shipping fees. Now, why is a profit and loss statement important for your business? A profit and loss statement provides insights into your business's revenue, costs, and expenses over time. You can utilize this statement to better understand your business's growth and make more strategic decisions to significantly improve profits. For example, if you notice that your Amazon advertising costs have increased significantly in the last few months, but your net profit has not improved, you can take some steps to increase the net profit, such as reducing the cost of goods, increasing the product price, investing in brand building activities to get more organic sales, such as strengthening your D2C brands or website, assists you in making smarter business decisions. Assume you have set a goal of increasing sales by 40% year on year. During the profit and loss analysis, you notice that your sales are fewer than projected, but your earnings are higher than the prior year. You can then spend more money on advertising to boost your sales. If, on the other hand, your sales are higher than expected, you may devote more time to tweaking your advertising and marketing activities to optimize earnings or invest in a new product line to expand your business even further. Now, there are numerous financial indicators seen in P&L statements, and understanding these indicators is critical for making sense of the report. Now, let me take you to the terminologies to be mindful of. First is sales revenue. It refers to the total amount of money earned from selling products before any deductions, such as cost of goods sold or expenses associated with product sales. Typically, analyzing sales revenue helps to determine the value of a business and establish long-term revenue goals. Sales revenue is the number of units sold multiplied by the average selling price per unit. Say, for example, if you sell 120 pieces of a product at $20 each, your sales revenue is 120 into $20, that is equal to $2,400. Next is net sales revenue. It is the total amount earned from selling products after discounts, customer reimbursements, accounting charges, and other expenditures are deducted. So it helps you in understanding the profitability of the products. Net sales revenue equals to sales revenue minus sales return minus discounts minus other deductions. Assume you sell 2,000 pieces of a product for $20 a piece, offer a $1,000 discount, and receive 20 items in return from the customers. So the net sales revenue is calculated as 2,000 into $20 minus $1,000 minus 20 into $20 is equal to 38,600. Next is cost of goods sold. It is the total cost of manufacturing a product. This covers the cost of materials, labor, inbound and outgoing freight, and any other costs directly associated with the product's manufacturing. If you do not manufacture the product, the cost of goods sold will be the cost of purchasing it from a supplier. So cost of goods sold is a variable cost that fluctuates based on a variety of factors such as raw material prices, labor costs, inventory costs, and many more. Next is overhead cost. These are the fixed costs for your business that are not directly related to the product manufacturing or sales but are required for business operations, such as advertising costs, marketing costs, employee compensation, Amazon fees, warehouse costs, and so on. Now next is gross profit. It is defined as net sales less COGS. In simpler terms, if you sell a product for $150 and the cost of goods sold is $100, your gross profit is $150 minus 100, that is equal to $50. However, this is not the actual profit. Other expenses including overhead and taxes are not included in gross profit. As a result, your net profit enters the picture. So Amazon net profit or net income is the amount of profit left in your bank account after deducting COGS, taxes, debts, and other overhead expenses. So net profit is equal to gross profit minus COGS minus taxes minus overhead expenses. Say for example, if you sell a $200 product with a COGS of $100 and overhead expenditures of $50, your net profit is $200 minus 100 minus 50, that is equal to $50. With SellerApp Sales Dashboard, you can analyze and drill down to understand the sales, net revenue, and profit margins. For that, firstly, you need to connect your Amazon account with SellerApp Sales Dashboard. So after logging in, this is how the SellerApp Sales Dashboard looks like. Under the Product tab, you will get an overview of number of products, orders, and revenue. On the left, the products are displayed along with its ASIN, SKU, category, brand, and fulfillment method. You can evaluate the products based on status, revenue, orders, units, added on, listing price, variable cost, and cost of goods. You can filter the product results here and group SKUs by ASINs right over here. Additionally, you can select the products and track them. You'll be directed towards Product Intelligence feature where you can improve multiple aspects of quality and performance of your listings. Now next is how to create a P&L statement as an Amazon seller. We understand how much sellers dread creating their company's profit and loss statement. We feel the same way. So follow these simple steps to construct a simple profit and loss statement for your business. Make a simple income and expense tracking sheet. P&L statements begin with the creation of a simple income and expenses tracking spreadsheet such as this one. To determine the net profit in all of the expenses and income from month to month, get Amazon's net sales revenue. Next, compute your company's net sales revenue. Fortunately, Amazon has made it simpler to obtain net sales revenue figures from the Seller Central account. In that case, go to Reports. Next, Payments in your Seller Central account. Navigate to the Date Range report and select Generate Report. Choose Summary. Choose a time frame and click Generate if you want to create a monthly statement. It displays your company's total Amazon expenses and net sales revenue for a given time period. Add this information to your income and expense tracker sheet. Calculate the cost of goods sold. The cost of goods sold enables you to determine how much money you are directly putting in the product. Say for example, if you are selling a wallet, you must add the cost of purchases as a cost of goods sold for the product for the given month. If you make the wallets, you must include the material cost, labor cost, and shipping cost, and other manufacturing related costs in your COGS. Now let's calculate the gross profit. Subtract the COGS from the net sales revenue to get your company's gross profit or loss. Net sales revenue minus cost of goods sold is equal to gross profit. Next is calculate overhead costs. In order to assess earnings in the e-commerce business, overhead costs must be accurately tracked. We recommend keeping detailed records of everything to avoid pulling out your hair at the end of the month when calculating overhead charges. So calculate your operating profit is the next one, which is calculated by subtracting the overhead expenditures from the operating profit. The operating profit equals gross profit minus overhead costs. If you have other sources of income such as interests or dividends from assets, add these to the operating profit to get earnings before interest, taxes, depreciation, and amortization. That is EBITDA. EBITDA is a valuable way to measure a company's financial health and ability to generate cash flow. If Amazon is your sole source of income, your operational profit equals your EBITDA. Next is calculate your net income. Now that you have the EBITDA, calculate your tax based on the type of business and deduct it from the EBITDA to get the net or actual income. If your EBITDA in January is $6,147 and your total tax is $1,278, your net profit will be $6,147 minus $1,278, that is equal to $4,869. The P&L data in the spreadsheet looks like this. You're not required to pay sales tax on your profits. Amazon collects and files sales tax for practically all states in the United States for a nominal fee of 2.9% each transaction. Now, how to analyze profit and loss statements to help your businesses grow? It can be intimidating to comprehend data. However, if you know where to look, you'll be a pro in no time. We have compiled a list of simple methods for analyzing the profit and loss statement. Examine your monthly sales revenue to see if it is increasing. Now, why did sales grow in certain months or specific periods? Is it due to seasonal demand, or did you boost your advertising spend for those months? To enhance sales, analyze the factors and reiterate them in the future. Then go over the cost of goods sold. It is the expense directly associated with your product. It will go up on its own as sales go up. However, you can still find solutions to lower the COGS. For example, get more discounts from suppliers by ordering in bulk or paying in advance. Look for reasonable cost suppliers who offer quality products. Request a line of credit and pay in installments to keep your company's cash flow stable. Lastly, calculate the profit margin and then examine how it stacks up against the profit margins of other businesses in the industry. If it's lower, attempt cost-cutting measures to boost your profit margin. Examining these insights will provide you with a good picture of your company's financial health, and it will assist you in making strategic decisions. Analyzing your P&L report can assist you to determine whether you can meet your profit targets and adapt your selling operations accordingly. Remember that even though your revenue seems to be substantial and you are selling a lot of products, the work is not worth it if your account is not profitable at the end of the day. Our piece of advice is to define specific and quantifiable goals. Your business outcomes will increase if you look at the big picture, analyze it, and validate your progress against targets you have set. And that's it for this video, everyone. Thanks for watching. Your support means a lot to us. It encourages us to bring out more helpful videos like this. If you found this video helpful, please like, share, and subscribe to SellerApp. Let us know if you guys want us to create in-depth seller guides on any specific topics. You can leave your suggestions in the comment section below and we'll definitely create them for you. If you haven't already, click the bell icon so that you will never miss on another video. And as always, happy selling!